Today, we're talking about stocks versus gold. Welcome to YCG, where we help your capital grow so you can achieve your financial goals. If that's something that interests you, then hit the subscribe button and the bell notification so you don't miss a thing. I'm Elliot Savage, and I'm here today with Brian Yachman, President and Chief Investment Officer at YCG, and also Will Kruger, our CEO. So guys, the first question that obviously comes to mind is, what is this fascination with gold, and how does it fit into an investment portfolio?
Well, I think first of all, it serves as an inflation or deflation doomsday hedge, right? It's over the long term, gold has kept its value, whereas paper currencies have lost its purchasing power over time. We have a very good idea about how much supply of gold there is out in the world. But with paper currencies, governments can print money and there's this endless supply. And so that's what you're seeing with regards to purchasing power and the loss of that within paper currency. So I think people have this infatuation with gold because it really has served as a store of wealth over the very long term.
Yeah. And like you said, I think it also is just a great hedge against, inflation and or deflation doomsdays, according to many people. But Brian, is gold actually a good hedge relative to stocks?
Well, relative to stocks, I would say no. I mean, as you can see from this chart here, gold has indeed held its value over the very long term. It's basically, after you strip out inflation, the same value today as it was centuries ago. But notice in the interim, it goes through these unpredictable periods. Sometimes it's lasting decades or even centuries where gold's gone down in value, or maybe gold has gone up in value. So over the long run, it's been a good hedge, but relative to stocks, not so much. I mean, and the reason for that is because the value of gold is completely tied to people's perceptions of value, which can dramatically change over time. Whereas stocks, it doesn't matter if the stock market's closed. If it's closed, your business still has value because it's ultimately based on the cash flow that's being returned to shareholders. Whereas with gold, you have to have someone who's willing to pay for it in order for it to have value. And so, when you think of businesses, they're just a collection of people. And so they're much more adaptable to changing circumstances. Whereas gold, it just sits there. It does nothing. In fact, that's exactly why gold was just as an alternative currency. It does nothing. It's not radioactive. It doesn't decay. It doesn't rust. It doesn't react with other elements. It doesn't do anything. And so it was chosen basically as an alternative currency. It reminds me of, Warren Buffett. He has this really great analogy, which, by the way, I mean, we know that someone in his organization purchased some gold, but I still love the analogy that Buffett he uses, where he said that you could take all the gold in the world, melt it into a cube, and it would fit inside a baseball diamond. And he said, imagine if you took all of that wealth, you could, if you wanted to, take that gold cube, sell it, and buy the 16 largest businesses in the world. As I recall, I think it was 16 of the largest companies in the world. And after you're done doing that, you can buy all the farmland in the United States, and then you'd still have $1 trillion of chump change left over. And so he says, look, think about it. I mean, decades from now, which one do you think is going to be worth more? The gold cube sitting in the field, or all of these businesses producing all of this cash flow for decades? And as he puts it, he says, you can fondle the gold all you want, but it won't respond. So that's kind of our view there. Gold's just that gold cube sitting in a field doing absolutely nothing. We'd much rather own businesses that are doing something, producing goods and services for the world. Carries value.
Yeah, great points, Brian. So I think the other thing to think about with hedges is what are you paying for them? And hedges really are a form of insurance. And so what are the hidden costs of gold, Will?
Well, based on Brian's last point, I think the biggest opportunity cost is not being able to invest in that amazing asset class of stocks, where historically, for the last 120 years, you've been able to grow your purchasing power over 2,000 times in real terms. And so I think that's for the biggest opportunity cost. Then there's also the cost of just storing and protecting your gold. And sure, the industry has changed and evolved with being able to purchase gold via an ETF, and that certainly has made it a little easier. But the whole point of having the asset class of gold is to protect your wealth in a draconian kind of scenario. And so, to me, if you own gold through an ETF, you don't really have that benefit of being able to securely own it or protect it. You have these treasure troves of gold that you can own through an ETF. But the government has in the past, and it certainly could come in the future, basically take ownership of that gold. And so if you own it through an ETF, I'm not actually really sure how beneficial that would be. Given those circumstances. But those are the two costs. It's really just the opportunity cost of being invested in stocks, but there's also the cost of storing and protecting it. And in a draconian world or a scenario, owning it through an ETF, I'm not so sure that's going to provide that diversification or that storage of wealth as people predict. ETFs are still very, very new to our industry. And seems to me that playing the gold ETF is much more of a trading mechanism and not necessarily a store of wealth.
And when you bring up the opportunity cost, Will, 2,000 times, right?
Right.
$1 in gold is stated $1 centuries later.
Right.
$1 in stocks, in just 100 years' time, a little over 100 years, multiplied 2,000 times. It's astounding.
Yeah, and it just speaks to the cash-producing asset of stocks, of farmland for that matter, right? Farming is not a high-margin business, but it's productive and has a step up relative to gold from that perspective.
Yeah. Anything that produces something is better than nothing.
Right, yeah.
Yeah. And, I guess the one other thing that I think makes a lot of sense to mention is that gold has held a pretty strong monopoly as an alternative currency throughout history. But will that be true going forward?
Well, I would say it's not necessarily true because I think we, as humans, we sometimes just think status quo, whatever it's been in the past, that's what it will be going forward. But, you consider the fact that cryptocurrencies, they actually have a lot of advantages relative to gold. They're cheaper to move around the world. They're much lower storage costs, as Will was just referring to. And so who knows? If cryptocurrencies take off, it's completely in the realm of possibility that gold proves to be a worse hedge in the future than it has in the past, as these cryptocurrencies could take meaningful share as an alternative form of hedging.
Yeah, absolutely. So we've made the case. I think it's pretty clear. Stocks are a better hedge in a lot of ways to the future than gold, and they create a lot of value. So thanks for tuning in for this episode of Common Sense. And if you have any comments or questions, please leave them in the comment section below. And in the meantime, check out our other videos, and we'll see you in the next one.